you've got the average per year, and you've got at the end, you've got the average for this entire century. Gold has increased year over year, every year. The average is 10%. And, they've been telling us, put your money in the stock market, you get an average 8% return over the long run. But for this century, if you were an investor, if you went back to 2001, when the Dow and the S&P peaked in the year 2000, if you inflation adjusted, it took to 2016 just to get back to break even. We're just barely, the stock markets are inflation adjusted, are just barely above. They're like 25% above where they were back in the year 2000. And gold is like 350% above where inflation adjusted. It's way above the year 2000. Gold and silver have been the strongest performing assets, other than a few of the cryptocurrencies, of this century. And this chart shows it. And what's amazing is how little red there is on this chart and how much green there is. So anyway, we'll skip to the next chart in the series that I wanted to cover, and that's on page 30. You have the U.S. gold price, the price expressed in dollars. And that's the way the world is, gold is priced in dollars all around the world, except on the Shanghai exchange, it would be priced in Chinese yuan. But here we have it in dollars. And then you have the worldwide gold price, and it is at all-time highs. It's at record highs. So you were just commenting about this before. When you calculate the world gold price, how many countries are you using to calculate this chart?
Well, this is based on a trade-weighted US dollar price. I think it includes the most important trading partners for the US. Of course, it is kind of skewed to the euro and the Japanese yen and some other big trading partners. But I think it's just important, to show that there's not only $1, not only one gold price. It is actually, for the farmer in India, he doesn't care about the dollar price of gold. He cares about the rupee price of gold, or let's say the exchange ratio between the rupee and an ounce of gold. So I think this is really important to describe and to explain to people. And the fact that you can see basically in 2014 already, this world gold price started making higher lows. And actually we're in this beautiful uptrend, and now it was taken out the all-time high. So that's just a very, very strong confirmation for our bullish case.
Yeah, that's interesting. The end of 2015 was the low in gold in the dollar price. But when you look at the low worldwide, that was actually toward the end of 2013. It was already rising. And then the next chart in your series is gold in euros, because the euro is such a big portion of this. Since the euro was introduced in 1999, the price of gold in euros has risen by 454%. So this chart goes back to the beginning of the euro, and it's pretty much a consistent rise. It's, with the exception of that pullback in 2012, 2013. It's interesting, in the United States, gold put in its high in August of 2011, but this looks like in euros that it was in 2012 that it put in its highs. Exchange rates. Do you find the whole idea of a worldwide monetary system, of all these floating exchange rates of pieces of paper that any central bank can print, is this insane to you?
It is, and I think they're of course floating, but they are all floating kind of down, as we can see in one of the next charts. So it is just interesting to see from so many different angles. We're calculating different products like Hershey chocolate bars or cars or admission tickets to Disneyland. Then we've got, of course, our gold beer ratio for the Oktoberfest in Munich. It's just so obvious that gold preserves your purchasing power, while in fiat money terms, you're just losing constantly. And this is something that we want to tell people and want to show people with different items from daily life.
Yeah, on page 32, your chart of the number of milligrams of gold that a euro is worth. It used to be worth 124.8 milligrams when the euro was created. And when you created this chart just a little while ago, it's worth 28.3. So it's lost 82% of its value against gold. And that means that its purchasing power as far as anything else that you want to buy has also dropped.
Yeah, and I mean 82%, that's just really dramatic. And we're calculating this from 1999, starting when the euro was introduced as book money, while the notes were only introduced in 2002. But I think, it is something that makes me very concerned, and the fact that also the European Central Bank continues to tell people, we need a weak euro for our economy and to stimulate growth and to stimulate our industry. That's just complete nonsense, because if you have a look at, long-term comparisons, it is only countries with strong currencies, with hard currencies, that are more productive and more successful, while countries with weak currencies, they just devalued. And from my point of view, a strong currency is something like a fitness program for a country. You have to be more innovative. You have to be more flexible. You have to have better products when you have a strong currency. And the fact that so many mainstream economists continue to say at the moment, we need a weak currency, this is just nonsense. And it is something that actually bugs me quite a lot.
Yeah, that brings us to our next chart, though, because you're comparing the US dollar, the euro, the British pound, and the Swiss franc against gold from 1971, when we went off of the Bretton Woods system, which was the last vestiges of sort of a pseudo gold standard, to today. And the Swiss franc has held up by far the best. And what I can't understand is why it is still holding up. Now, I could understand why it was holding up back in the 70s and the 80s. I believe that they stayed on the gold standard for a little while longer. It was one of the very few countries that remained on gold for a little while after Nixon ended the Bretton Woods system. But you see that throughout the mid to late 70s, it holds up a lot better. It didn't fall as much in purchasing power as all of the others. And that lasted until actually today. But this is a logarithmic chart. And so when our viewers are looking at it, they have to realize that each millimeter on this chart represents a certain percentage increase or decrease. And if you look at the drop in the value of currencies at the very, in 2019, this year, if you look at that drop, the British pound has dropped the most, and then the euro, and then the US dollar, and the Swiss franc has dropped the least here. There's very little drop. But what I find amazing is I went on the Fed's website after looking at this chart, and I generated a chart of US-based currency, which Ben Bernanke inflated by 300% when he did quantitative easing 1, 2, and 3. It was more than 300%, but it did some quantitative tightening. Then I generated the Swiss base currency supply. They have increased their currency supply, their base currency, 1,100%. We did it 300%. They did it 1,100%, 1,100%. And yet their currency is still holding up better than ours. And I can't understand that. What do you think's going on here?
Well, I think, that the fact that the balance sheet of the Swiss National Bank, it reminds you of a hedge fund. Some would say a poorly managed hedge fund.
The Mickey Mouse Club run by the Three Stooges. Sorry.
Well, they're one of the largest shareholders of many stocks in the FANG space. And from my point of view, it's not the role of a central bank to be an active investor in the stock market, but we could discuss it. But the fact is
immoral. They're bidding real assets away from the public, trying to raise the price of the stock market by printing currency and buying it. Now they own a bunch of the shares of the stock market that we couldn't buy at a lower price and be an investor in a logical market. The entire world markets are just broken. They're completely illogical today.
Yeah, I couldn't agree more. And I mean, if we were central bankers, we would probably, if we would have to do some sort of QE, we would buy gold instead, or perhaps some Bitcoin. But I think, the fact that the Swiss franc is still a safe haven is the reason is not only their fiscal situation that is, of course, much better, in much better shape than in most other European countries, but it's also the fact, from my point of view, that the Swiss franc in its monetary DNA still has this gold backing, and on a per capita basis, the Swiss hold still one of the largest amounts of physical gold. So it is not a coincidence, but they really try everything to weaken the Swiss franc, which is quite sad.
I also think, you were saying that strong currencies lead to a strong country, and the Swiss, they do have a strong economy. It's one of the favored places to live, and they've got decent tax situations and so on. I don't know that much about the Swiss economy, but I do know that it's a very desirable place to live and do business. But I believe that, since all of this quantitative easing and stuff, that they're really riding on their reputation at this point, because they have gone off the deep end with creating currency and buying assets. And that's immoral. It's just wrong. And they're debasing their currency supply, yet people don't see it that way for some reason. Hi, it's Mike Maloney, and I'm back with an interview with
Ladies and gentlemen, this is Christopher Aaron. Welcome back. It is November 27th, 2019. We're going to look at a topic that is very much in discussion these days, especially in the precious metals and the currency markets. The U.S. dollar. Is the dollar going to crash? Do we have any evidence for that or not? And how might this impact gold? How is gold reacting to the U.S. dollar? So let's take a look at all this or more. I want to wish those of you here in the U.S. a happy Thanksgiving coming up this weekend. And tomorrow, of course, Thanksgiving Day. And those of you in the rest of the world, enjoy your week as well. Let's dive right in. So when I'm analyzing a question like this and attempting to arrive at some sort of a meaningful answer to the possibility for a dollar crash, if you're on this channel, I like to look at things in the most data-driven way possible, which to me is what is the market, the sum of all participants in the dollar, what is the market actually saying? So I know that there are people who like to approach this from a fundamental standpoint, and I understand a lot of the fundamentals. For example, the 100 trillion plus in unfunded liabilities here in the U.S., Social Security, Medicare, all these programs are pretty much bankrupt. We could talk about, the massive debt, trade deficits in this country, trade wars, which are probably going to make things worse, et cetera, et cetera, And so I understand those fundamentals, but you have to understand the logic behind this type of analysis. If you're just going to pick one or two or five fundamentals and say, well, therefore I disagree with you, Chris, you have to ask yourself, how many of the known fundamentals are you actually referring to? What percentage? So if you say the unfunded liabilities is the game changer, and that's why this analysis is not going to be accurate that I'm going to show, what percentage of the fundamentals is that unfunded liabilities? How would you know? How would you have a way of quantifying that? Is that 100% of the fundamentals? Is it 1 out of 1 data points? Or is it 1 out of 10? Or is it one out of infinite? In which